in conversation with Christopher Woods of CLSA. Chris, hi. Good afternoon. Thanks so much for joining us and speaking to us at Bloomberg Quint. What's your view on the mother market? Let's start off with that, because as I read your note in October, you agreed that if corporate tax cuts are dashed, the US markets would decline, but it's unclear whether the tax reforms are actually reforms, or the landmark tax reforms, or just restricted to tax cuts. Is that a big determinant of what the US markets will do over the course of the next 3 to 6 odd months?
Yeah, no, I agree with that. In my view, on a sort of 3-4 month view, the US tax debate is the key issue for the US stock market, more important than Fed policy. I also agree that the key issue is whether it's tax cuts or landmark tax reform. I would say right now the odds are still 50-50 on landmark tax reform. So it'd be nice to have a very strong view one way or the other, but I don't think that's rational. It's clear that the Republican Party in Congress needs to get some kind of tax package done by the end of Q1 next year, well in time for the midterm elections. But I think the critical issue for markets is whether it's landmark tax reform, which they're definitely trying to do, or it just turns out to be something less dramatic, just a corporate tax cut.
So how would that place how the global markets do? Because the 3 or 4 large markets, I mean, all large markets are right now trading at multi-year highs, save for China, which has also rallied quite a bit ever since you were one of the few ones who went overboard China about 18 months ago as well. What's the global market scenario looking right now? Is it uncertain, or do you reckon that this rally that we have had for numerous years now could well continue?
Now, for me, in terms of Asian markets, specifically Asian emerging markets, I remain very constructive. My view remains that Asia made a multi-year bottom in terms of relative underperformance at the beginning of 2016. At that time, many global investors thought that China had lost control of its capital account, the China currency was going to collapse. That marked the peak in negative sentiment on China, and I think we've begun a period of extended outperformance in Asian emerging markets. However, the risk if you buy Asian equities today is that Wall Street remains more overvalued than ever. So the risk is that something happens to cause a correction on Wall Street and you have a correlated sell-off globally, which would be quite healthy technically, to have a bit of profit taking, and that would be a great chance to add to your Asian equity positions. But I remain firmly overweight Asian emerging markets, and I think Asian portfolios need to be concentrated in the 2 markets my portfolios are concentrated in, that's China and India. As you rightly know, the big story this year has not been India. The big story in Asian equity markets has been China, which has outperformed all other markets, and that's been a pain trade for many global emerging market investors because they began the year underweight China.
Well, yeah. So just before I move on to India, Chris, my only question to you is, would you believe that I heard you mention that if indeed there is a correction in Wall Street and thereby a Wall Street-led correction into the other markets, then we could have a problem on our hands. Would that be the only nature of correction that could bring Asia down, or could there be internal factors which could disturb this rally for China, for India, for some of the other large Asian markets?
Well, to me, I think internal factors are less likely. One, talk of near-term issues, the most likely potential cause for a sell-off, apart from US overvaluation, concerns about Fed tightening, etc., or tax reform not happening. The other obvious news flow that could precipitate more market concerns relates to this news flow in the Middle East, which has been very dramatic of late. That could disrupt markets if Middle East tensions led to a disruption in oil supply. But so far, the rally in the oil price we've seen has been relatively mild or moderate, given the very dramatic nature of the news flow we've been seeing in the Middle East.
Let's assume it's ceteris paribus, Chris. We don't hear too many disruptions. What about India individually? We perched well and truly above the Mount 10,000. valuations a bit stretched, earnings in quarter two not as bad as quarter one. Do you think the numbers start showing themselves in the second half and will justify the kind of valuations that we are at currently? Is it possible to be able to predict and forecast that?
Yeah, well, I'm still comfortable sitting with I've got a structural 3 times overweight in India in my relative return Asia ex-Japan portfolio. I'm still comfortable with that. I did reduce that overweight a bit actually at the start of this quarter, precisely because the valuations were high. However, I restored it back to a triple overweight when we had the announcement of the bank recap. In my view, that was the missing link in the Indian equity story. I think there's been a huge number of positive reforms introduced by the Modi administration since the BJP government took power. But there's been one big missing link, one failure amid all the many successful reforms they've introduced, and that's been the almost total failure to address the problem in the banking system, which actually was inherited by this government. So in my view, that is the chief reason why the investment cycle has continued to trend down and why bank loan growth has been running recently below nominal GDP growth. But obviously, we've now had the announcement of the bank recap. So assuming that is implemented, that I believe creates light at the end of the tunnel in terms of this downturn in private sector capex and investment and credit growth. So on a 2 to 3 year view, I think one can now look with reasonable confidence to a resumption of an investment cycle, not necessarily in the next 12 months. That I think creates a much more positive medium-term outlook for Indian equities. The other point is, though the forward PEs are very high, we also need to remember that profits as a percentage of nominal GDP in India are at relatively depressed levels precisely because there hasn't been an investment cycle. So if and when an investment cycle happens, there is significant potential for profits to recover. But I'm not saying, I don't think one can say with confidence there's going to be an investment cycle recovery in the next 12 months.
Yeah, well, actually, we were speaking to Larsen and Toubro yesterday, and they referred to the fact that we are entering into an election year in India might well not bring back the investment cycle with much gusto. So I think they kind of echo your sentiment. But just before we move on, Chris, I just had one small question. You referred to the PSU bank recap, and we'll talk about the micro as well. That plus the GST rate cuts that have come in have gotten the bond markets in India a bit worried about the fisc situation, and if indeed we will stick to the fisc glide path that the FM had hinted at, or could there be a disruption thereof? How are you reading into all of that?
Well, no, there's clearly been a bit of a sell-off in the Indian bond market, but that also may be partly correlated to the backup in the 10-year Treasury bond yield. So personally, I would definitely favor equities over bonds in an Indian context. And so mutual fund investors in India, I would advise not to be more overweight equities than bonds. But in my view, the bank recap, while it's got some negative fiscal implications, is fundamentally positive because it should lead to stronger nominal GDP growth in India. So to me, that's a positive. On the GST, there's obviously a highly complicated process which has been made worse by India's federal structure. So you have all these different tax rates. Normally when GST is introduced in a country, you only have 1 or 2 tax rates. So there's going to be all kinds of teething problems. But the key point is that it's being introduced, and those problems, I've got confidence, will be in due process sorted out. So to me, the key GST in my view is a positive. My key question mark in India at the start of this quarter was when's bank recap happening? Finally, it's now happening. I would say though the government has wasted 3 years. They could have made this announcement 3 months after assuming office. It was obvious at the start of this government that there was already this banking problem, and actually the government inherited the banking problem. So by not addressing it immediately, that what was a previous government's problem and responsibility has now become their problem.
And they seem to have addressed it for now, at least. My question, though, Chris, a follow-up to that is, would this therefore mean that investors could take a fresh look at PSU banks at the current levels? Because what that announcement did was that the very next day, the bank valuations reverted to mean, which was about 1x book. Now, you had a chance to spend about 2 days or maybe more in India, take stock of things. Do you reckon that there is more in store for the PSU banks in terms of a rally? And are they good to go from the levels that they are at currently?
My base case, you do get more of a rally in the public sector banks, but whether you want to sell your private sector banks and buy public sector banks, that to me is just a short-term trade. I wouldn't do that. If you were fortunate enough to own the public sector banks, though, before the announcement, then I would definitely stick with the public sector banks, particularly the best ones. But obviously there is a risk, though, that the best public sector banks who are benefiting from the recap will be asked or required by the government down the road to do national service and take over some of the worst public sector banks. So to me, there is that potential risk. So for conservative investors, it makes sense to stick with the long-term growth stories in private sector banks, and they remain one of Asia's best growth stories because I believe 70% of deposits in India are still in the public sector banks. So that's 70% of deposits that can go to the private sector banks.
Okay, last couple of questions, Chris. Firstly, amongst all the notes that I've read coming in from your end, I believe you are bullish on the Indian property market. My question to you is this a call taken by the India team and you're endorsing it, or are you personally believing that there is money to be made in the Indian property stocks? Because those stocks haven't given investors too much to cheer over the last maybe 6 to 8 years.
We're positive on the Indian affordable housing sector.
Okay.
When I say we, CLSA's Indian office, and I myself am, we're positive on the Indian affordable housing sector, which is a sector which is being actively promoted by the government, both in terms of creating incentives for developers to develop in this area and making affordable housing cheaper for buyers. On the real estate market itself, I think that's in the midst of a sharp downturn caused by the implementation of the RARE Act and the attack on black money created by demonetization.
Fair ball. Last couple of questions, Chris. Firstly, while we've spoken about the domestic factors, what about the export-oriented themes? Because a rising global GDP would probably mean good news for all exporters, services and manufacturing. Is that a reasonable assumption?
Yeah, but we've had a big pickup in export growth this year in Asia, but it's important to understand the big driver of that export growth was driven by demand from China, not by the Western economies. And we think the growth rate will now plateau out. So I would only invest in Indian export plays on a bottom-up basis. But in the big picture, India is a domestic demand story, and one's portfolio should be dominated by the domestic demand aspects of the Indian stock market.
But no single theme stands out? I mean, would technology or any of the specific manufacturing pockets stand out, or would it only remain bottom-up?
Sectors, none of the export sectors particularly stand out to me. I think compared to the private bank story in India or affordable housing, I think they've got much more issues relating to them. Also, the global economy is not, the Western economies are not as robust as the current hype makes out. US economy has been growing only 2% year on year since 2009. And my base case is that's the trend growth rate is going to continue to be at. The risk to me is that the US economy slows from here, not accelerates. European economy has picked up cyclical momentum this year. It's got a better growth rate than America, but that's because it's had so many years where it hadn't recovered at all, so it's sort of pent-up demand.
Okay.
A big driver of export rebound this year globally has been demand from China.
Fair call. Christopher would have loved to talk more, but understand you have meetings to attend. Thanks so much for taking the time out and speaking to us at Bloomberg Quint.